for FMX Connect, and I'm here today with Peter Beutel, President and Analyst of Cameron Hanover. He's an energy analyst, actually. So basically, Peter, how are you?
I'm doing well, thank you.
I'm fine. So 2008 had been a wild year in terms of oil prices. I mean, we reached highs of around $147 a barrel and lows as around $32 a barrel. I mean, coming up from an end of $40. How can you explain this volatile behavior?
Well, it was certainly one of the craziest years we've ever seen. We've seen oil bubbles in the past. We had one in 79 and 80 where prices went up to a high of 39.80. In 1990, we had one that took us to 41.15. And the lows were $9.75 and $10.35.
It wasn't Russia crisis?
Well, it was actually after the first Iraq War. We started at 9.75 in 1986. We went up to 41.15 in 1990, and by 1998 we got back down to $10.35. And it is an interesting thing that one of our strongest periods of growth during the 1990s was accompanied by low real oil prices. Let's go through what happened in 2008. And really the story could be taken all the way back to Hurricane Katrina and Rita in 2005. But something dramatic happened in the summer of 2007. And we at that point saw the United States lowering interest rates. The Federal Reserve lowered interest rates. And interest rates, to a large extent, determine the relative currency values, so that, let's say there's a higher interest rate in Europe. Money will flow from the United States to Europe, and in that process, the euro will increase and the dollar will drop. Funny thing though, all the commodities in the world are denominated in dollars. So as the dollar weakens, commodity prices have to rise in order for them to be the same price in euros or yen or yuan or whatever it may be. Through last July, when we reached $147 in crude, the dollar was extremely weak. And as prices dropped, it corresponded with a rise in the dollar as the dollar rallied. And that really went through the end of December 2008. When we reached a low of 32.40 right before Christmas. A lot of things happened with the price rise. There was very strong demand in 2008. China, of course, had the Olympics, and it had an insatiable desire for diesel fuel. We saw American demand for energy very, very high.
And also, I imagine because the crisis already started taking place, many investors were running into commodities investments that were probably safer, or less speculative in a way.
You saw a lot of investment money coming into the commodity complex and into oil. And when I was trading in oil in the 1990s or watching oil in the 1990s, really it was the supply and demand of oil that was the most important factor. In 2007 and 2008, and even as we sit here and speak now, factors like equities, factors like interest rates, or the US dollar are now more important. We've got the very, very strange situation right now of oil prices making new highs. They've increased, they've doubled.
That had nothing to do with supply and demand.
And it's had nothing to do with supply and demand. Demand right now for all refined products is down about 7% against a year ago. Inventories are very high, so we've got poor demand and plentiful supply, and yet because of a weak dollar, oil prices are making new highs. And this was one of the big factors that led us to $147 oil back in July of 2008.
I understand. But then, this year, since the low in 2008, the prices of oil start like increasingly going up, in the same way that securities and the dollar price as well. How can you explain this? How this happened? I mean, is it this has to do with like that the economy is apparently recovering, or people think that it's recovering, and is the demand matching this recovery, or still the demand is as low as it was before? I just wanted to know what is your opinion about this.
Well, you bring up a very good point, because the thinking has been, the equities market, the Dow Jones Industrial Average, stock markets are improving. And so that should lead to an economic recovery, and with an economic recovery, we'll use more energy and more oil. It hasn't happened yet, but there is this feeling in people's heads that it will happen at some point. And so you're seeing this major disconnect between the oil markets and supply and demand, where prices are rising because the dollar's weakened, because there's this vague feel-good feeling that the worst of the recession is behind us, demand will improve somewhere down the line. And so people are buying oil. A lot of these index funds are buying oil as a hedge against inflation or against a weak dollar. And they're pushing the price higher, even though supply and demand is as sloppy and as bearish as it could possibly be. Lots of inventory, lots of oil, very, very poor demand. So we have not yet seen any of the changes that are anticipated by the increase in equities or by the decrease in the dollar.
And this was Flavia Maceto for FMX Connects. I hope to see you very soon.